What is going on, everyone? Mr. Banks here. So this video is going to be over fair value gaps. What's a fair value gap? What is CB? What is this? What's the consequent encroachment, as well as inversion fair value gap? So the first thing we are going to go over is what is a fair value gap. So a fair value gap is a 3-candlestick pattern where the low of the first candle does not overlap with the high of the third candle, or it's a 3-candlestick pattern where the high of the first candle does not overlap with the low of the third candle. So this is bullish fair value gap, and this is bearish fair value gap. The deeper meaning into that. And we are going to back this with market structure to help us pick high probability trade setup going along with the trend. So a fair value gap is a 3-candlestick pattern where the low of the first candle does not overlap with the high of the third candle. So this is a bearish fair value gap. So since we have this example here, the low of the first candle does not overlap with the high of the third candle. So if we extend this right here, we extend the low of the first candle and also extend the high of the third candle, we have this gap between them here. That's what we call the fair value gap. Basically what we call the fair value gap. So this is a bearish fair value gap because the low of the first candle does not overlap with the high of the third candle. So this is a fair value gap. In the same example on the bullish fair value gap, the high of the first candle does not overlap with the low of the third candle. So this is a bullish fair value gap, and that's what we call the FVG. That's a buy-side imbalance, sell-side inefficiency. So what makes a fair value gap invalid? What makes a fair value gap invalid is when the low of the first candle overlaps with the high of the third candle. We extend the low of this first candle and also the high of this third candle. We could clearly see that this low overlaps the high of the third candle. So this makes what a no fair value gap. Let's move to the bullish side. So this bullish fair value gap is when the high of the first candle does not overlap with the low of the third candle. So this makes a legit fair value gap. So what makes this fair value gap invalid or a no fair value gap? The low of the third candle overlaps with the high of the first candle. So we have the high of the first candle here, and this becomes the low of the third candle. So this makes a no fair value gap because the low of the third candle actually overlaps with the high of the first candle. So how do we now pick an entry from a fair value gap? So what we normally do is, for a fair value gap to become valid, we need to see both lows and highs does not overlap with each other. So with this sell side imbalance, buy side inefficiency here, this is a fair value gap, and if we want to take an entry from this fair value gap, so for me to take an accurate trade from a fair value gap, you need to be able to identify that this fair value gap is accurate. And what do I mean by that? For price to pull back into a fair value gap, you need to see price tapping into the fair value gap, react to the fair value gap, and closes below the fair value gap. Or we might have price come inside the fair value gap and closes around here. It's still a valid fair value gap. Or we can have price go higher above the fair value gap and closes right above it or right beneath inside the fair value gap. So this is still an accurate way to take a trade from the fair value gap. And from the bullish perspective, what we normally do is, once you take an entry from a fair value gap, price can actually come into the fair value gap at least 50% of the fair value gap, or price might actually come all the way down here, comes below the fair value gap and pushes. right back inside the fair value gap. So you might have price giving some kind of patterns like this. Price comes all the way inside the fair value gap and closes around here. This zone is still valid to take an entry from here to the upside. You trading along with the trend, and this level right here is also confirmed that you can actually take an entry from here and push price all the way to the downside. So let's take a live market example on this fair value gap. So this chart right here on gold, you need to identify what our fair value is. And first, we need to identify that we are in an uptrend and we are only looking for buying opportunities. We need to identify our buy side imbalance, sell side inefficiency. So we can have our first fair value gap right here, which the high, the low of the third candle does not overlap with the high of the first candle. So we first have our fair value gap here. So what we are going to do is we mark this as our fair value gap. And we expect price to come and tap this fair value gap, give us what a good trade entry. And we can target this size as our take profit. See how it goes. The price taps into our fair value gap, and you see price pushes all the way back, hitting our take profit. So what basically happened here was, if we actually want to take a trade on a smaller time frame perspective, then we can actually scale down to the 15-minute time frame. As price tap into our fair value gap, we can wait for price to give us what a reaction. Then we take our entry after a candlestick confirmation. Then we target this highs as our take profit levels. So let's have our next example on gold. This is basically going to be a bearish fair value gap. So we see price came all the way up here, broke above structure and what gave us a change in market structure. Right now we are only looking for selling opportunities. You can also identify this huge fair value gap here. So this is basically a sell side imbalance, buy side inefficiency. We had this huge fair value gap here, but then we can't take our entry inside this fair value gap. So we wait until price comes into at least 50% of this fair value gap. That's what you call the encroachment of this fair value gap before we take our entry. So when you mark from this level to this low here, you can clearly see that this is where we have what our consequent encroachment of this fair value is 50% of this fair value gap. So let's take off our fair value gap here. And right now we know this is 50% of this whole bearish fair value gap. So as price comes back to tap into our fair value gap, what do we do next? We wait for confirmations. So the confirmation that we actually wait for is price what giving us a change in delivery, change in state delivery, or a market structure shift on a smaller time frame to also take our entry from this particular level here. So what we do next is we actually identify our fair value gaps here. So we have our fair value gap here. And following this particular trend, we could clearly see that this fair value gap lies right inside our premium channel. We have our first fair value gap, then we have what our second fair value gap. But we are looking for entry confirmation. So what we are going to do is we are going to pick our entry and price react to any of this fair value gap. So here we see price come all the way up here, tap into our fair value gap, but failed to close above our fair value gap. So we pick our entry right after this candle close inside of this fair value gap. Set our stop loss right above here. Then we can target this swing lows as our take profit level. You see price spike all the way down, pushes right down here. So this be picking our entry from this fair value gap, targeting this structure. So the next thing we are going to talk about is consequent encroachment of the fair value gap. The consequent encroachment of the fair value gap is basically 50% of this fair value gap. The consequent encroachment of the fair value gap is actually basically 50% of this whole range. So 50% of this whole range is what we call the consequent encroachment. So for price to actually deep dive into, the next thing we are going to talk about is consequent encroachment. The consequent encroachment of the fair value gap is basically 50% is for range. You clearly see here that 50% of this fair value gap is right here. So when price is pulling back into a fair value gap, we expect price to at least respect this 50% of this gap. At least goes above it, come back close below for us to take our entry. But when price closes above the consequent encroachment, we will still focus on the next candle reaction. Price closes below the 10, we can take our entry. But when price closes above this consequent encroachment and also overlaps this whole fair value gap, then this fair value gap becomes valid. So most of the times, we can actually take our entry from the consequent encroachment and target our structure to when we are in a bearish trend. When we are in a bullish trend, we need to identify our consequent encroachment of this whole fair value gap. So we see this middle line to be our consequent encroachment. So price can actually come all the way down our FVG and close right above the consequent encroachment. That's the 50% range of this value or this buy side imbalance, sell side inefficiency. When price closes above it, then we can take our entry based on the confirmation on the next candle. So this is the consequent encroachment of this value. So let's go right into the chart for a live market example. As price tap into our higher time frame order block, we are actually looking forward, but then we want to take our entry from this fair value gap. So what we are going to do is we are going to be able to see the next candle close. So our next candle close bearish. Then we have our fair value gap sitting right here. And another fair value gap also sitting right about here. So we need to identify our consequent encroachment of this. That's basically 50% of this whole range. And we want to take our entry around the 50% level. We don't want to see price close above our 50% level, or we don't want to see price close above this whole FVG range. So you see price tap into our level and close exactly around our consequent encroachment, which is 50% of the fair value gap. So you can take our entry from here. Just leave our focus right about here. Then we can actually target our structure as our take profit levels. You see price come all the way down, spike through our take profit. So an inversion fair value gap is when price actually invalidates what a fair value gap to the upside when we are in the bearish trend, and when price invalidates a bullish fair value gap to the downside when we are in a bullish trend. So let's take a live example. So as price is trading around here, we have our sell side imbalance here, which as price trades around this level, we see price pushing all the way up and closing above this fair value gap. So when we actually push out the low of our first candle and also the high of our third candle, you will clearly see this fair value gap being violated. So this is basically where we have what an inverse fair value gap, because this fair value gap has been inverted. We normally do is when price violates a fair value gap like this and it becomes inverse, wait for price to pull back into it. Then we take an entry to the upside. Because when a bearish fair value gap is inverted, it becomes what a support level to push price all the way to the upside. Same vice versa, we had this bullish fair value gap here, and price comes all the way down and breaks below this fair value gap here. This fair value gap here becomes what an inversion fair value gap, and we expect this to be used as a form of resistance to push price all the way to the downside. So this is basically the whole meaning of an inversion fair value gap. So that's basically when we are in a bearish trend and we see a bullish candle pushing all the way up and violating a bearish fair value gap, we always want to see price pull back into that same level or that inverted fair value gap as a form of support to help push price to the upside. And when we are in a bullish trend and we see bearish candle violating a bullish fair value gap to the downside, we also expect price to push all the way back into the fair value gap, for the fair value gap to be used as a form of resistance to push price all the way to the downside. So let's go back to the chart and look for a live market example. So on this good, so this is basically our last example on inversion fair value gap, and this is good chart on the 30-minute time frame. So we're in a strong downtrend, we're in a strong bearish trend, and price actually created this fair value gap here. Actually looking to what take short when price actually pulls back into this fair value gap on the smaller time frame. So basically we're expecting price to pull back into this short and take what an entry to the side. So we had our CB here, that's the sell side imbalance, buy side inefficiency, sitting right here. So as price plays, we had our next candle breaking and closing way above this sell side imbalance, buy side inefficiency. Right now, this becomes what an inverse fair value gap or an inversion fair value gap. So this fair value gap right here becomes what a strong support level to help push price all the way to the upside if you have any kind of pullback into this fair value gap. Let's see how price moves. So basically we have, so as price broke above this bearish fair value gap, price pushed all the way to the upside and also created another bullish fair value gap here. So we actually have a sell side imbalance, buy side inefficiency switching to a buy side imbalance, sell side inefficiency. So right now we have this inverse fair value gap here, two fair value gaps overlapping with each other. So what we are going to do is we are going to wait until price comes back into this level whilst we take our entry to the upside, because our fair value gap here has now become what a strong support level to actually take into. So we extend this to the right side, then wait for price to actually come back into this particular level. And again, what we are going to do is we are also going to identify our consequent encroachment. That's 50% of this fair value gap, and that's where we actually want price to come all the way down into, and price should not close below this very low here. We want price to just react off around here, then we continue to the upside, because we have this fair value gap here which has been inverted, and then we actually have this fair value gap here which was actually inversed and is right now serving as a strong support to push price all the way to upside. So as price comes down, we pick our entry from this FVG, they come all the way down into our 50% level. That's the consequent encroachment before price actually took off all the way to the upside. You actually see price pushes all the way to the upside, sweeping liquidity above this very place. I hope you found this video helpful. If you did, then please consider liking and subscribing for more content. See you guys.